So the U.S. Federal Reserve System, often referred to as the Fed, serves as the nation's central bank and plays a crucial role in managing the economy. To accomplish its objectives, the Fed employs several key tools to control the money supply, which influences interest rates, spending, and investment. Understanding these tools is essential for grasping how the Fed works and how it navigates economic challenges and fosters stability. One of the primary tools at the Fed's disposal is open market operations, aka OMO. This involves buying and selling government securities, such as treasury bonds, in the open market. When the Fed purchases securities, it injects money into the banking system, thereby increasing the money supply. This action typically leads to lower interest rates, encouraging borrowing and spending by consumers and businesses. Conversely, the Fed sells securities and withdraws money from circulation, which decreases the supply and can lead to higher interest rates. Through OMO, the Fed can effectively influence the overall liquidity of the economy and steer it in its desired direction. Another tool is the discount rate, which is an interest rate charged to commercial banks for short-term loans from the Fed. By adjusting this rate, the Fed can influence banks' willingness to borrow and lend. When the Fed lowers the discount rate, it makes borrowing cheaper for banks, which encourages them to lend more money to businesses and consumers. On the other hand, raising the discount rate makes borrowing more expensive, which can restrict lending and slow down economic activity. This tool also allows the Fed to manage the flow of credit in the economy, impacting consumer spending and business investments. Reserve requirements dictate the amount of funds banks can hold in reserve against deposits made by consumers. By changing the reserve requirement ratio, the Fed can directly influence how much money banks can lend. Lowering the reserve requirement allows banks to lend more of their deposits, thereby increasing the money supply. Conversely, raising the reserve requirement restricts lending and decreases the money supply. And finally, the Fed uses interest on reserves as a tool to manage the banking system's liquidity. By paying interest on the reserves that the banks hold at the Fed, the central bank can influence other banks' lending behavior. A higher interest rate on reserves encourages banks to hold onto the reserves rather than lending them out, while lower rates incentivize lending. This is another mechanism the Feds use to control the money supply and stabilize the economy. Yeah.